Good afternoon to our lecturer, Puan Shamsina. My name is Nur Syafiqah Izzati binti Adnan. Metric number is F1107. Okay, today I will be presenting an important topic in accounting. Is the recognition and reporting of trade payables, provision, and contingent liabilities and assets. Okay, first, let's begin with trade payables. Okay, trade payables, also called accounts payable, are amounts a company owes to its suppliers when it buys goods or services on credit. Instead of paying immediately, the company agrees to pay later, usually within 30 to 90 days. For example, if a company buys 5,000 worth of inventory on credit, it has a trade payable of 5,000. This is classified as a current liability because the company is expected to pay it within the next 12 months. Okay, next we have provisions. A provision is a liability, but with some uncertainty. It is a present obligation that arises from a past event, but we don't know the exact amount or timing of payment yet. Okay, we have three conditions must be met to recognize a provision. The first one is there is a present obligation due to a past event. Second, it is probable that the company will have to make a payment. And the last one is the amount can be estimated reliably. Okay, for example, this is a product warranty. If a company sells products with a warranty, it knows that some units might be returned or repaired in the future. The company must set aside an estimated amount for this future cost as a provision. Next, we have contingent liabilities. These are possible obligations that may or may not occur, depending on future events that are outside the company's control. Okay, contingent liabilities are not recognized in the financial statements, but they are disclosed in the notes if, first, it is possible, not probable, that the company will have to pay, or second, the amount of the obligation cannot be reliably estimated. Okay, the example is a lawsuit. If a company is being sued, but it is unclear whether it will lose or how much it will have to pay, this becomes a contingent liability. By disclosing this in the notes, the company is being transparent with its stakeholders. Okay, what are contingent assets? Contingent assets similar to contingent liabilities. We have contingent assets too. Okay, these are possible assets that may arise depending on the outcome of future events. Okay, for example, if a company is suing another party and is likely to win, it may receive compensation. However, this compensation is not recognized yet because it is not certain if the chance of receiving the benefit is probable. It can be disclosed in the notes. If it is virtually certain, only then it can be recognized as an asset. This is to prevent companies from showing profits before they are actually confirmed. This is just from me.
My name is Syafiqah Shazbina binti Muhammad Syuhaimi, metric number F1133. Today, I would like to explain the three items that are reported in the statement of financial position. Firstly, let's start with account payable. Account payable refers to the outstanding amount that a company owes to its supplier for goods or services received but not yet paid for. This liability arises from the company day-to-day operation and usually involves short-term obligation that must be settled with a normal operating cycle. typically with 1 year. In the statement of financial position, account payable is classified under current liability because it represents debts are due in the near future. Efficient management of account payable is crucial as it directly affects the company liquidity and working capital. A company must ensure timely payment to maintain good relationship with supply and avoid penalty or disruption in supply. Secondly, we move to loan from a bank. A loan from a bank is recorded as a liability because it represents an amount the company has borrowed and must be paid. When a loan is due within 12 months from the report date, it is classified as a current liability. If a company has taken a long-term loan, only the portion of the loan that is due within the next financial year is presented as a current liability, while the remaining balance is recorded under non-current liabilities. Proper classification of bank loan help user of the financial statement assess the company short-term obligation and its ability to meet them using its current asset. Manage loan repayment efficiently is important to maintain financial stability and a good credit standing with bank. Finally, the third item is warranty to customer. A warranty to customer is an assurance given by a company that it will repair, replace, or otherwise compensate customer if a product fails to perform as promised within a specific period. Even though the company may not yet know exactly how many products will require repair or replacement, it must still estimate the expected cost and record it as a provision. A provision for warranties is recognized because there is a present obligation and a probable outflow of resources to settle the obligation, and the amount can be reliable estimate. This estimate is based on historical experience, industry average, or expected defect rates. Recording warranty provision ensure that expenses are matched with the revenue. They help to generate in line with the accrual principle of accounting. It also gives a more accurate picture of the company liability and future cash outflow. That's all for me. Thank you.
Assalamualaikum Puan, nama saya Arifah Fahimah binti Yusof. Nombor matrik saya F1120. Saya akan menjelaskan tentang situasi yang satu. Situasi satu ialah mahu PhD file a legal suit claiming RM 200,000 and it is highly probable that they will win. For the recognition, Mawar PhD has filed a lawsuit and is highly probable to win the case. In accordance with Malaysian Financial Reporting Standard, that is MFRS 137, provisions, contingent liabilities and contingent assets an entity must assess whether an inflow of economic benefits is probable and whether the amount can be reliably measured. In this situation, Mawa BHD has initiated legal proceedings against one of its suppliers for unethical use of the company's brand name in promoting their product. The amount being claimed by Mawa BHD is Rm 200,000. Based on the legal opinion obtained, it is assessed that there is a high probability that Mawa BHD will win the lawsuit. However, under MFRS 137, a contingent asset must not be recognized in the statement of financial position unless the realization of the gain is virtually certain. Since the outcome, while highly probable, is not yet certain, Mawa BHD is prohibited from recognizing the Rm 200,000 as an asset at this stage. Recognition will only be appropriate when the final court decision confirms the gain without any possibility of reversal. Thus, no asset is recognized at the reporting date. For presentation in financial position, although the contingent asset cannot be recognized, MFRS 137 requires disclosure of such contingent assets when the inflow of economic benefits is probable. Therefore, Mawa BHD must disclose the existence of the legal claim in the notes to the financial statement. The disclosure should include a brief description of the nature of the contingent asset that is Rm 200,000. For the summary, no recognition of assets until realization is virtually certain. For the presentation, that it is required to disclose the contingent assets in the notes with sufficient details. Now, for situation 2 is Orchid BHD has been sued. It is probable that the company will be liable, but the amount cannot be reliably estimated. For the recognition, the company that is Orchid BHD is likely to lose the case and be liable, but amount cannot be reliably estimated. This is a contingent liability. In accordance with Malaysian Financial Reporting Standard, that is MFRS 120, accounting for government grants and disclosure of government assistance, government grants must be recognized when and only when there is reasonable assurance that is for the first point, the entity will comply with the conditions attached to the grant. The second, and then the grant will be received. In this situation, Mawa BHD has received approval for a government grant of Rm 300,000 to assist in the construction of a new factory. Since the grant has been approved and is non-repayable, it indicates that the conditions for receipt have been satisfied and the collection is reasonably assured. Thus, Mawa BHD should recognize the government grant in its financial statement during the period when the grant becomes receivable and the conditions are met. For presentation in financial position, for the first point, do not recognize as a liability in the statement of financial position. For the second point, disclose in the notes to the financial statement, including nature of the obligation and possible financial effect. As the grant relates to the construction of a long-term non-current asset that is the factory under MFRS 120, Orchid BHD has two options for accounting treatment. Option 1. Present the grant as a liability on the statement of financial position. Then, release the liability to profit or loss over the useful life of the factory, matching the depreciation expense. Option 2. Deduct the grant directly from the carrying amount of the asset that is the cost of the factory. This results in lower depreciation charge over the useful life of the asset. Whichever method is chosen, it must be consistently applied to all similar grants in future periods. Thank you, madam.